Well, Dalal Street ended Friday and the week with losses. The sensex and the nifty lost 1% each for the week, with IT stocks falling the most on Friday. But how are equities poised for 2023? Will China become the tactical play for the next year? And what are the implications of falling crude oil prices? We discuss all this and more on this week's edition of the Editors Roundtable, starting now. I'm Sonia Shanoy, and with me, I have the editors with me. There's a special guest as well. So, folks, thanks a lot for joining in. It was a week when I think the final nail on the coffin was on Friday, when the IT stocks got hit very hard after HCL Tech mid-quarter said, you know what, we may not meet our guidance in entirety. They lowered it. That was a sour point, but all in all, not such a bad week for equities, you'd have to say.
Not such a bad. I thought you were going to start with FIFA, though. You know,
That's for the weekend.
But I think all of us are Nigel.
Who are you going with?
I'm going. By the way, it's interesting where people say, let's watch the match together. Where are you going? Which pub? Which bar? I'm going to my kids' school. Because Amish is with us as well. Amish, of course, is head of research at Bank of America. I'm going to my kids' school. They're having an airing. Not the late one, but the 8:30 one. So I'm there.
Exciting plans.
Do you have a view on before the markets? What about the FIFA? I mean, are you tracking it?
Are you backing it?
That's the most difficult one to predict.
Usually around, I remember the last FIFA World Cup, there was all this analysis done about what happens to markets when, the country which is hosting it or
the octopus as well.
The octopus.
Right?
Oh, absolutely. That octopus used to always get it right. But Amish, I mean, since you're here with us, thank you for joining us in the studio. How are you feeling? It's the end of 2022. I can't believe this year has just flown by. How are you feeling about the markets?
So, first of all, thanks for having me. As far as next year goes, I think we are in for, again, a volatile market. As investors starts to debate the outlook for global macro next year, I think we'll see Nifty go to 17,000 on one side. Yeah. We'll also see Nifty go to 20,000 on the other side. Our bias is that by the end of the year, markets will be more on the top end of that range, which basically means that we are looking at mid to high single-digit returns. And as a result, India could continue to outperform the developed markets, but we will underperform the emerging markets next year. Okay. In order to maximize alpha or returns, I think one will have to be nimble. More importantly, two strategies will work. One is to keep buying the dips, and we can discuss why we think buying the dips will make sense next year. And the other is to rotate within sectors that have near-term triggers or near-term themes.
I mean, so more of not a trader's market, but you're going to be more nimble, as you said.
Absolutely. So trader, I would say that you will have those themes play out for 6 to 9 months. Yeah. So if you time those well, those are the pockets of generating alpha next year.
And we'll come back to each of these specifically in a bit from now. Let me just pull back a little bit. You gave us the whole range for the next year. But how's the very near-term setup, right? So we've been talking about this 20-day moving average for the Nifty. And I think on Friday, the market did break that. And we actually went to almost 18,400 and 400. But by close, the market came back to closer to 18,500. We ended above that. And we are exactly at that 20-day moving average. I mean, it's a near-term level, but it's watched widely, watched very closely. So, I mean, I think that's the big one as we head into next week. As I think Amish also pointed out, recent history suggests that buying the dip has worked. So, more often than not, that has worked. So, is there any big, overwhelming reason to change that? Perhaps no, not at this point in time. I would look at client positioning, but this is as of Thursday's data because we don't have Friday's numbers. Both FI and client positioning is very, very low. I mean, the long positions are very low. So you can kind of look at it both ways. You can say it's a good thing. They're not at extreme levels earlier, but you can also say that are they now going to go short? So that's the other way to look at this. Banks still, I think, hold the key to the market. They're the strongest part of the market. PSU banks, though, all pulled back. Bank of India, on Friday, that is. And by the way, they did that with some of the highest volumes since February of 2021. Markets have rallied, the PSU banks have rallied so much, and then a reversal, which is to the tune of 7-8% in many of these stocks on very high volumes. I mean, I think you need to be watchful there, whether it indicates a bit of a change in trend. IT see the big sell-off, and I think the voices around this slowdown, recession in the US are only growing louder. Oil prices, I think it's a big macro positive, but is it all positive? I think that's the question, because history suggests that when oil comes off, it also indicates a bit of a risk off. It's deflationary. It doesn't stoke risk appetite in that sense. And next week, of course, in terms of a global push, You got the CPI, the Consumer Price Index number, and it's followed the next day with the US FOMC decision. So it's, I mean, there's lots to track in terms of a global trigger as well. But the 20-day moving average, I think that's the, in a way, not the Lakshman Rekha, maybe some other Rekha, but it's an important one. Nimesh, dealing room check. You got the pulse.
Prashant, again, to me, it looks like there's a week of consolidation. No panic as such, whether you call the FI flows or for that matter, the retail participation, there seems to be there. Turning a bit selective, but again, that's the participation is there. So I wouldn't call it as a panic, so to speak. And I guess the Nifty is struggling to go about that 18,900 level. That's a crucial level for a big breakout from those levels. So I think that's something to watch out for in the very immediate term. On the downside, maybe 18,300 is acting as a very strong support. So that's where the Nifty could find a support there. I guess the big sector of the week and has been the trend for the last many weeks has been the PSU banks. And now we are seeing upgrades pouring in. We saw Morgan Stanley upgrading the multiples and target prices of most of the PSU bank stocks towards the weekend. We saw even Credit Suisse raising Bank of India to outperform, and they've raised a target price on PSU banks. But now the big question is they all are inching towards the one-time price to book on FY22. And normally we've seen some bit of profit booking or underperformance around those levels. So the big question is the big rally in PSU banks over? I don't think it's over yet. No, I mean, it's a tough to call or give a judgment, but that's something which people have been talking about. I think that in terms of liquidity, the trend of the Ps exiting, the promoter selling stake, that seems to be continuing. We saw a couple of large block deals this week as well. I believe even next week, though it's going to be light in terms of volumes for the next 3 weeks, but there are few blocks lined up. So that's something, that trend continues. I guess on the macro, the big positive for India is the fall in crude prices. And that's why, you're seeing the biggest proxy to macro, the banks, and they've done well. For the last few days, even in terms of flows, the banks is where you're seeing a bit of flows as well. So that's the setup for the next week. The banks are expected to do well. No panic selling, so to speak. But I guess Nifty is struggling to go beyond that 18,900 levels, and that's something to watch out for.
Absolutely.
Okay, well, that's about the local markets, right? But Nigel, the big, of course, positive headline is that China has opened up, post its zero COVID policy. I think it was 3 or 4 years. It's removed all its curbs. But that's the big question. Is it a threat to Indian equities in 2023? And you've done some research on that.
Well, guys, since it's a weekend, India seems to be all heart. But maybe, in fact, market wants to have a bit of a fling with the Chinese market. So that, on that note, let me drive this point forward. And most experts that join on the channel, well, they have been suggesting one thing. India is the preferred investment destination. However, in the near term, China could possibly be a tactical play. So let's take that point forward then. China, remember, they have been talking about exiting the zero COVID policy. So more rational China, could it be a bit of a risk for the Indian markets? Well, higher metal prices is something that the street is debating on, and it could have its impact on metal stocks. The bigger question is higher input costs, could it impact earnings? That could be a bit of a risk. We'll have to see how that combination plays out. Next up, this year, 2022 has belonged to India. We have seen solid returns in terms of the Indian markets. However, the last 1 month or so, well, China has been outperforming. So, that throws some bit of caution that maybe some kind of money is moving to China. And I was looking at the flows. There's a Macquarie note that's come out. And, they have given the flow picture of China. And China has seen good amount of inflows in the month of November. To be fair, emerging markets on the whole, they have seen a good amount of inflows. India included, even ex-China, emerging markets, we have seen a good amount of inflows. But China, well, in the month of November, after a few months, you saw strong inflows out there. Keep in mind that, the globe basically has gone underweight China. Or the weightage, if you look at the MSCI emerging markets, it's come down substantially. From around that 43%, it's come down closer to around 30%. And India, remember, has been a beneficiary because our weightage has nearly doubled. Finally, valuation-wise, India is expensive, right? I mean, in relative terms, or if you compare it with the other markets or historical data, well, we are trading at close to around 21, 22 times odd. China is available at around 10.5 times odd. So valuation-wise, China has some cushion. The big question is, will that tactical switch take place, and will it be a bit of a risk for the Indian equities in 2023? Well, we'll find out soon.
All right, Nigel, thanks very much for that. I mean, but 11 times 20, the old, the China Sasta Mal. And I mean, but that's, I'm not, the point about China is interesting because I read an article, I think it was in Atlantic or it was a New Yorker, which said the vaccine in China is actually, compared to the other mRNA vaccines, etc., or even what we've used here, is very subpar. The efficacy is very low. So is China's hand also being forced because of all these protests and what that means is if, casualties start to grow, COVID-related debts start to move up, will this be a non-stop reopening process or will this have stop-starts, etc.? Amish, but, for the purpose of this discussion, as Nigel pointed out, does it hurt or does it help?
Do you think the world wants to have a fling with China in the near term?
You can answer that in those terms, fling or love affair.
So surely, for next year, we think China will do well, even if it is tactically. The markets, as you rightly pointed out, is really cheap. Economy is opening up after a long time. People would want to travel. Discretionary spends will pick up. So China will do well. But the big question that investors keep asking me all the time is that China recovery from a market's perspective, does it come at the cost of India? And that, I think, is a big no.
Okay.
Historically, if you plot the data, we have seen that the direction of the flows for India and China is unidirectional. In other words, if China gets flows, India gets flows as well.
Right.
And the reason for this is quite simple. Over 90+% of the funds that invest in India are actually non-India dedicated funds. So these is EM pool of money.
Almost 95% or something.
Absolutely. So if money does get allocated to the emerging markets, you can under-allocate to India, but it is very unlikely that it is going to be negative flows for India. So the positive China story is actually a positive FI inflow story for India.
For India as well. And to be fair, even the month of November, actually, the flows into India, they were good.
Absolutely.
China, it was a little bit better in comparison to what we saw in the previous months. But for India, as you said, yes.
Absolutely. So, Nigel, that validates the argument that if you look at the whole of this calendar year, India, one could argue, was doing very well economically. But because China saw outflows, India saw outflows as well. November, China saw inflows, India saw inflows as well. It just goes.
But at the margin,
together.
we were talking about, because it's been such an extreme situation, it's not been normal, right, with the lockdown, etc. At the margin, people have been saying, will we start see the emergence of India dedicated money, emerging market funds ex-China? I mean, those kind of conversations were starting to come about. So at the margin, maybe it does. That momentum maybe pulls back a little bit, right?
Absolutely, Prashant. So don't disagree with that, but that pool of money is very small.
It's very small. It'll take a long time to grow.
Absolutely. So it is catching up as a theme, but I think it is not meaningful at this point in time.
Okay, I do have a few more questions for you, but in the interim, let's also get Nimesh, to tell us about how global equities are expected to shape up in 2023. Nimesh, over to you.
So, Sonia, we are just 3 weeks away from entering into 23, and that the big question in the mind of investors is how the 23 is going to look like. So, I've just looked at almost 300 pages of brokerage reports across some 15, 18 brokerages, and I've looked at the data for both global and for the Indian markets. Now, first look at the global data and what the global themes looks like. As far as the big themes are concerned, there are the four big themes that globally one has to look out for: the recession theme, the inflation theme, Fed pivot, and the China reopening. These are going to be the big 4 themes as far as globals are concerned. Some big reports have come out from influential brokerages. So what is Credit Suisse saying? Credit Suisse is saying that 2023 is going to be tale of 2 halves. The first half, the focus is going to be on higher rates for longer theme, which means that the equity performance will be muted. But in the second half, as central banks pivot, they are expecting investors to rotate to high interest sensitive sectors with a growth tail. So that's the view from Credit Suisse. Look at what Fidelity has to say. Fidelity believes that cyclical recession is the most likely outcome in 2023, which means that they remain cautious on the global equities. However, they are very bullish on ASEAN and Indian markets. So that's a big bullish view from Fidelity on India. I've put out some number as well. Morgan Stanley has put out the numbers for 2023. They have an S&P target of 3,900. They have a DYX of 104, and they've put out a Brent target of 110. That's the number which Morgan Stanley has put out for 23. But what this all means for the Indian markets. Now, for India markets, I've put out 4 big themes. The first big theme is the big India outperformance. 22 was a big year of India outperformance, so we need to see whether that can continue. We are sitting on very peak valuations, and the sentiment is quite bullish as well at the retail end. So that could be a bit of a negative for India. The waning commodity inflation, that's the only positive thing which can play out for India in 23. And the retail flows, which have been a big backbone for India, that is something to track in 23 as well. What are the brokerages saying? So, Goldman Sachs has put out a target of 20,500 for end of December 23, but they believe that India is unlikely to outperform for 3rd year in a row as China and other cyclical markets like North America opens up, and they may do better. So that's the view from Goldman Sachs. In terms of sectors, they're overweight on sectors like banks, insurance, industrial, cement, and utilities, whereas they're underweight on names like IT, NBFCs, consumer durables, and retail sector. So that's the Goldman Sachs view. Look at Morgan Stanley. Even they believe that they have a target of sensex target of 68,500. But even they believe that India's relative gain may take a breather in 2020. So that's summing up as a big theme for India as well. In terms of their sector overweights, they're overweight on financials, technology, consumer discretionary, but they're underweight on most of the other sectors. In fact, we have Amish with us, but even I was looking at the BofA Securities note, and they have a target of 19,500. And what Amish pointed out, it could be a very volatile market for us with a range between 17,000 to 20,000. And within sectors, they're overweight on financials, industrials, staples, and utilities, whereas they're underweight on IT, discretionary, autos, telecom, and pharma. So the big theme is India can see a bit of a breather in the first half of 2023.
Okay, Nimesh, thanks for that. And what I noticed is that a common thread is most of these large brokerages or fund houses are all underweight on the IT sector. Amish, I wanted your thoughts here because, this week was important, right? I mean, HCL Tech mid-quarter has come out and said we won't meet our guidance. This is after raising their guidance last quarter in Q2. So do you think there's incremental weakness despite the 20-30% falls that these stocks have seen?
Sonia, the short answer is yes. And if you look at it over the last 15 years, we have seen 3 such episodes. One during the global financial crisis, the Eurozone debt crisis, and the digital disruption. Every time there is a global cyclical issue or a global economic cycle tapers off, we've always seen IT constant currency revenue growth come off. And this time around, unfortunately, the valuations for the sector are quite high too. And as a result, we think the revenue growth guidance will keep getting curtailed and the stocks will come off.
Amish, what stood out for me within your sector weights is metals. You're overweight on metals. It's a bit of a non-consensus view, so to speak. Why you're bullish on metals and which metals you think will do well in 2023?
So first of all, we are very bullish on the capex cycle. Okay. If you believe that, I think domestic demand for metals will pick up. And obviously China reopening helps as well. So on the back of these 2 things, we think both steel and non-ferrous will do well. Non-ferrous, we were always bullish, but we have recently upgraded steel too.
Okay, in fact, we want to take that discussion forward since we're talking commodities. A big fall in crude was also the headline of last week. So we'll slip into a short break. Don't go anywhere. We will return. We'll also talk about the events that the market can look forward to next week. So do stay tuned in.